This is a tax measure that allows retirees to donate to charities, meet the minimum required configuration, and pay zero federal tax on the same transaction. This is called Qualified Charitable Distribution. Most eligible retirees either don't know it exists or abuse it. Today, we'll analyze in detail how it works. Why is it better than regular charitable deductions? 4 downstream tax breaks that the IRS would never announce. Let's start with what this technology actually solves. If you have a traditional IRA, the government won't let your money sit there forever. At a certain age, whether you need money or not, you have to start paying. This forced evacuation is known as the required minimum allocation, or RMD, due to the Securities Law 2.0, signed at the end of 2022. The age at which you have to start is delayed. If you turn 72 after the 31st of December 2022, your RMD now starts at 73. Born in 1960 or later, you get more television because your RMD 1T take effect until you are 75. That is a big problem. Every dollar of RMD goes to your tax return as normal income. That means it could push you to a higher tax bracket, increase Social Security, taxable, trigger medical insurance, surcharge, quietly eliminate eligible deductions. RMD is more than a withdrawal. It is a domino that upends the other 4 parts of your tax return. Now, let's turn to practical technology. If you are 70 and a half or older, the IRS allows you to send money directly from your IRA to a qualified charity, and the transfer is not included in your taxable income at all. This is called Qualified Charitable Distribution. This transfer is included in your current year's RMD, unlike normal withdrawals. None of this will show up as income on your tax return. No deductions, no write-offs, but the tax code is invisible. In 2025, the IRS limit was $108,000 per person per year, up from $105,000 in 2024. Now, under Security 2.0, the ceiling is linked to inflation every year. Married couples have restrictions if both have individual retirement accounts. As a result, a family may transfer a large amount of money to charity without receiving a dollar from taxable income. That alone would be a powerful tax measure. But that is the real magic. CDS doesn't just help you save on income taxes when you withdraw money. It lowers your adjusted total income. AGI is a number that builds on the rest of the tax code. Remove that number and the other 4 things will quietly work in your favor. Let's take a look at one at a time. The first is Social Security. Up to 85% of benefits can be taxed on so-called temporary income for a single file manager. Once temporary income exceeds $25,000. Benefits are taxed. More than $34,000. Up to 85% is taxable. Married couples apply together for $32,000 and $44,000. Regular RMDs push you to these numbers. The QCD slid past them. Medicare ranked second. There is also a surcharge called IRMAA, means the monthly adjustment amount related to income. As your income increases, this increases your Medicare premiums. Standard Medicare Part B premiums in 2025 are $185 a month, but the first IRMAA threshold for single or co-applicants is $106,000 or $212,000. That premium has soared. On the first floor, you pay $259 a month for Part B instead of $185. It was a surprise because IRMAA is based on your tax return from 2 years ago. That is to say, your IRMAA in 2025 is calculated based on your earnings in 2023. QCD lowers your AGI. That will keep you below those thresholds for years to come. Third, new early deduction passed as part of the 2025 tax code. This deduction provides $6,000 in rest for individuals 65 and older, or $12,000 for eligible couples, can be superimposed on standard deductions. Phasing out singles starts at $75,000 and co-filers start at $150,000. Reduce income above these thresholds by 6%. Reducing MAGI through QCD protects deductions from cancellation, and the windows are short. Unless Congress decides to extend the new deduction period, the deduction will only appear on the books for tax year 2028. Fourth, this is the most surprising one. The vast majority of retirees accept standard deductions. In 2025, it was $15,000 for singles and $30,000 for couples. If you are single, people 65 or older can get an extra $2,000. If you apply together, $1,600 per eligible spouse. When you accept standard deductions, your regular cash donations to charities generate zero federal tax breaks. Zero. You wrote a check and got nothing back. Q. The CDs sidesteps the whole issue because money is not revenue. No subdivision. No clear threshold. Tax cuts are on your lap before calling your IRA custodian. There are rules you absolutely have to follow because the IRS is very strict with it. The money must be transferred directly from your IRA trustee to a charity if it enters your bank account first, even a second time. The whole thing was disqualified. The charity must be a qualified 501(c)(3). There is also a list of specific organizations that are not included. These include donor-advised funds, private foundations, and support organizations. QCD comes from Traditional IRA, Inherited IRA, and Inactive SEP or Simple IRA, but they can T-quit your 401k plan. That means you have to transfer the money to the IRS. First, you can't benefit from it. So no party tickets, no charity auctions, no golf games. And you must be 70 and a half on the day of transfer. Not later this year. Security 2.0 also has a built-in time option that few people have mentioned, a QCD limit of up to $54,000 once in a lifetime to fund a charitable gift annuity or a charitable residual trust. The figure is also related to inflation. Now, let me be blunt, because QCD is not always the best philanthropic initiative. If you own stocks that have skyrocketed in value, donating these value-added stocks directly may bring you a better comprehensive tax effect, especially if you specify. The real tension with the new high-level interpretation is understandable. Ed Slott is perhaps the most cited IRA expert in the United States. Some argue that a complete Roth transformation could backfire because the conversion increased your taxable income and phased out the new deduction of $6,000. The same logic actually strengthens the theoretical basis of QCD because QCD does the opposite. Income is lower, not higher. Speaking of Roth's conversion, this is another tactic you'll see on YouTube called trick. The goal is to use the so-called gap year between retirement and age 73 to slowly move money from the traditional IRA to Roth. Taxes are low today, so when RMD strikes, you have duty-free money waiting for you. It is a legal drama, but this is a multi-year project that requires careful stent management. After the tax law was passed in 2025, things really changed. If you're considering switching, it is time to sit down with a real CPA or expense planner and calculate the numbers based on your situation, not YouTube videos. Let's get back to where we started. A technical headline is to do a lot of work here, but the underlying mechanism is real. It has been included in the tax code since 2006. In December 2015, the PATH law was passed into permanent law. Eligible charitable grants allow retirees aged 70 and a half or older to meet their RMD, support the causes they care about, covering 4 major downstream interests: lower Social Security taxes, lower Medicare premiums, retention of early deductions, and tax breaks even if you don't itemize them. For a retiree who already plans to donate to charity, doing this in cash rather than through the IRS is one of the most costly mistakes you might make quietly after retirement. Share numbers with professionals. Verify the current year limit on the IRS website before transfer. If you find this useful, the best thing you can do is send it to someone in your life who is about to start RMDs, because once you withdraw cash, that year's tax-exempt window closes.